Hi, everyone. This is Jason Bierk of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He is CEO of McAlvany Financial. He's a second-generation money manager and the McAlvany Group of Companies. He's also the host of the McAlvany Weekly Commentary, which is a very good weekly show that you can learn a lot about investing, talks about a lot of global macro topics. He's also a gold and silver bullion dealer, so we can maybe get some insights about the silver shortage that's going on later in the interview. David McAlvany, thank you for joining me again.
Jason, great to be back with you.
So, David, we're recording this interview before people ask what day we're doing this on. As on Wednesday, November 2nd, 2022, the Fed just announced another 75 basis point rate hike. I think that's the fourth one now in the last four Fed meetings. So a lot of rate hikes lately from the Federal Reserve Bank. But what do you think are the greatest risks to the global economy right now?
The greatest risks to the global economy are still coming from Europe and China. And there we continue to see slowing economic activity, rising inflation, particularly in Europe. And so we still have yet to deal with the full ramifications of that. The IMF is coming out with new numbers suggesting that they've overestimated global growth and going to have to downshift on their expectations going forward into next year. So here we are in the U.S., kind of the bastion of strength, or as a friend of ours used to say, at least about the U.S. dollar's the best looking horse in the glue factory. You could describe our economy similarly. We're looking pretty good on a relative basis, but that doesn't mean that we'll stay sort of, at an elevated level for long.
David, correct me if you disagree with me, but it seems the more the Fed raises interest rates, the more they're making things even worse for the U.S. federal government and for themselves. If they crash asset prices, if real estate really starts to crash, and we're seeing a lot of signs of this with problems with Airbnb, sales in many real estate markets in the United States, home prices slowing. If asset prices crash, won't that cause enormous problems for the U.S. Treasury? I mean, next year with these interest rate hikes, if this pace continues, isn't it looking at around $1 trillion per year in interest payments on the rapidly growing U.S. national debt in 2023?
Yeah, I don't completely disagree, but I'd say they would respond it's tomorrow's problem, and the yield curve pretty much represents that as well. So increased interest rates now means there'll be decreasing interest rates down the line, and I think Powell made that pretty clear. They are nowhere close to finishing the hiking cycle, and they'll deal with the ramifications of that when they need to. He implied we have the tools. You saw how we worked in 2020. We have the tools. So again, just to reiterate, I think the yield curve is already projecting that. But are the rate increases today going to cause problems? Absolutely. What are the ramifications? Tomorrow's problem, as far as the Fed's concerned, or at least as far as Jay Powell's concerned.
Yeah, I don't trust the Fed, and I don't think they have any credibility. I mean, every time we've had a rate hiking cycle post 2008, 2009, it's just blown enormous things up very quickly with asset prices or credit markets. Look at the 2019 repo madness crisis. And now we have pension funds, David, getting intraday margin calls, whether they're pension funds in the European Union, United Kingdom, US, Japan. It's absolutely bonkers.
I would say that Jay Powell maintains some credibility, and this most recent hike was a part of that. Not just because it went up 75 basis points, but because he spoke his mind very clearly in the face of a market that wanted him to acquiesce to some form of a pivot or give an indication of when they would be loosening financial conditions. And he said, "No way, not going to do it. You can't have it." So for me, that is relatively strong in terms of credibility. He's made some missteps. You can go back to the fall of 2019. That was probably the biggest. May add another few in there, but I think he's someone who's operating with integrity, and probably upset a number of regional Fed chiefs with his Q&A.
So if the Fed is selling bonds, reducing their balance sheet, and China and Japan are not running trade surpluses, not reinvesting their trade surpluses into U.S. Treasuries, pension funds don't seem to be buyers of U.S. Treasuries, they have margin calls. Who do you think are going to be the buyers of U.S. Treasuries and the largest net buyers then going forward?
We haven't seen it yet, but as a part of a Treasury initiative or some sort of a legislative initiative, you can always define, according to quote unquote prudent man rules, that banks have to carry a certain number of Treasuries, that individual investors in their 401ks, IRAs, investment accounts need a certain prudent man allocation to fixed income. That's a possibility that does not exist today. And I don't have a particular time frame for when something like that might be experimented with. But central banks can obviously stop what they're doing in terms of QT and move to QE pretty quickly. We saw that with the Bank of England. And so, did they even get to 3 days? I think it was still anticipated, the launch of QT, and they went straight back to buying paper and expanding their balance sheet even before QT had really been started. So I wouldn't worry too much about that, because desperate people do desperate things, and the expansion of a balance sheet or a doubling from, say, 8, 9, 10 to upwards of 20, they wouldn't blink at it.
But there seems to be limits, though, for other countries besides the United States. So Japan seems to finally be hitting those limits where there's a correlation between government bonds, purchasing them, and the money supply. They seem to have finally hit it because they don't have cheap energy anymore. They're not running these massive trade surpluses to go and buy US treasuries, play games with their currency, make sure that they don't have a rapidly devaluing currency. And now Japan, what the yen's at 150, I think it's above 150 Japanese yen to the dollar now. And they're announcing almost daily intervention programs. So do you think that these other countries are hitting a limit with their bond bank programs and QE compared to the Federal Reserve Bank in the United States?
Yeah, there's no doubt. If to your earlier question, we did have to resort back to QE, that would put pressure on the U.S. dollar. Being at the elevated level we are, I think the Fed would look at that and say we've got a little room to maneuver there. And clearly Japan is the poster boy for abuse in terms of QE and the consequences showing up in the currency. 147.76 is the current exchange, and it's been under tremendous pressure. I think the other currency to watch here is the Chinese, which broke 7, and that was kind of the line in the sand. It moved pretty quickly. If you go back just a few weeks, 9/16, middle of that month, we were 7-1. Now we're 7.3. For the offshore, 7.29 for the onshore. It's telling you something. It's telling you that there's things that shouldn't be done that are being done, and flight capital from China, weakness in the currency. Yeah, currencies are key to watch here. So I think your point's well taken. If you're looking at the currencies, they're going to tell what the ramifications of the unintended consequences are to the policy choices that are put in place, be those fiscal or monetary policies. So the currency is kind of the tell-all.
Yeah, I agree. Historically, governments and central banks cannot save both their government bond markets and also their currencies. So they can choose one or the other when they get in a financial trouble. And normally it's after a major war.
Tough choice, but you're right. They're going to have to choose between bonds and the currency. And I think as far as the Fed's concerned, they would much rather keep the liquidity plumbing open and support the bond market, and not, and of course you're talking about supporting myriad leverage players out there by doing that, and let the chips fall where they may in terms of the currency exchange.
So a couple of minutes ago, you talked about the banks, the large U.S. banks, the primary dealers being able to buy more U.S. treasuries. As of right now, I think they have about 10 or 15% of their balance sheets allocated towards U.S. treasuries. But do you think then that there would be some type of rules change? I think post-World War II, either post-World War I or post-World War II, the large U.S. banks were carrying up to 40% of their balance sheet in U.S. treasuries. Do you think some similar type of post-war policy will have to be enacted maybe by the Federal Reserve Bank or the Treasury to accommodate the amount of treasury sales and the budget deficits the federal government's going to run? If they're going to keep raising interest rates and allow asset prices to fall, then they're going to force these treasuries onto the banks?
Yeah, could be. And then of course you can add some sort of a guarantee, right? So it takes away some of the pressure, or if they feel like they're taking risk, wouldn't be credit risk necessarily. I mean, at least from the bank standpoint, you and I might ultimately view treasuries as having some credit risk, but that's not today. So it's just rate risk. And if they've got some sort of an implied guarantee or backstop of some sort, again, it's just about keeping the liquidity flowing, keeping the financial plumbing, if you will, intact.
What are your thoughts on these pension funds and bailouts? Do you think that these pension funds that are getting margin calls all over the world, really, in Europe, the United Kingdom, Japan, the US, that because they leveraged their balance sheets, some of them did at least. I think CalPERS 20%, they leveraged their balance sheet by 20%. They were announcing press releases back in 2019. Do you think that they're going to need large bailouts at the government level?
Yeah, I just don't think we've seen anything yet in terms of financial hemorrhaging. We'd like to think the worst is behind us, and on a really good day, I've got pretty positive thoughts about that. But the reality is, we've moved to such excess in terms of valuations, whether you're talking about stocks or bonds, and you're talking about so much leverage in the system that the unwind is going to force something that we haven't seen we've seen it to a degree with the government being a buyer of last resort. But what does that look like? That's where I don't think we've really seen anything yet. We've had sort of Act One and at least a 4-act play. Maybe it's whatever, but the pension funds, this is what you get when you plan with leverage. You're going to take some losses at some point during stages of the cycle. And I don't think that the pensions here in the U.S. have had to record very many losses. Well, another way you can make all of this pain go away is just change your accounting standards and the reporting requirements that you have. We've seen that with FASB rules before. Let somebody get real creative with FASB rules, and whatever the losses are, they don't matter because look, they don't matter. So that's another way of relieving tension, and it doesn't put any stress on anybody's balance sheets. It just means that you cover your eyes, hold your nose, and pretend that it doesn't exist. But again, I think that's where the more you play games like that, you will see international players discount the dollar or begin to see more of a premium trade in the metals, where people say, yeah, I want something outside of the world of counterparty risk. I think that's where you see investors, hedge funds, and others look at gold with a very different perspective, a survival perspective, really, from a financial standpoint.
Yeah, I agree. Actually, we'll talk about gold in a little bit. There's some very interesting stories coming out about gold and silver. We're at gold prices at $1,635 an ounce. Silver prices at $19.20 an ounce when we're recording this interview. They're a lot higher in other currencies, though. In other currencies, the metals prices are doing a lot better than in the US dollar, which is relatively strong. The dollar index is above 112 on the news of these additional rate hikes.
Yeah, it's almost like a stealth bull market where you've got the better part of 7.5 billion people looking at the metals this year, 2022, and saying, banner year, great year, no complaints. And in the US dollar, where we've had, a one-off spike, really, we haven't had this kind of strength in the dollar in 20 years. So in US dollar terms, and again, that smaller fraction of the global population, less than 300 million people, and then start looking at investors who really give a rip about the price of gold in dollar terms. And you're talking about a fraction of a fraction of a fraction of the global audience for metals. So I look at 1635 and 1920, and I think in US dollar terms, that's a deal. But understand, this is kind of a stealth bull market where the rest of the world can pile on almost a momentum trade because they've done so well in their local currency terms. Meanwhile, you've got a little bit of whining going on in the U.S. markets. And I think you just take the dollar out to the woodshed for a week, a month, a quarter, and that tune changes very quickly.
And on a relative basis, I think gold's actually holding up pretty much the best. I think on a percentage basis, the losses are the smallest compared to pretty much every other asset class other than energy. The energy market has been on fire the last 12 or so months for oil and natural gas prices. I know there's a global diesel shortage too.
Yeah, I mean, silver obviously 17.4 down for the year, and gold off 10 relative to the equity markets, relative to the bond markets. Yeah, that's very true. I mean, if you're talking about our U.S. bond markets, investment grades off over 21%, high yield off 12, and I think that'll change as we transition from this being a rate sensitive fixed income debacle to a credit sensitive fixed income debacle. But TLT, a proxy for your 20, 30-year treasuries, is down almost 34% this year. Would I take a hard asset like gold off 10 and arbitrarily off 10 because of the currency conflation, or TLT, uh, place me in ounces, please.
Well, also the other major asset class, the next maybe shoe to drop is if the Fed keeps hiking interest rates, and it sounds like they're going to keep doing it at least in the short term, they're going to crash real estate. I mean, real estate, a lot of investors, a lot of people listening to this podcast are not aware that besides bonds, real estate is also very sensitive to asset prices. I mean, look, if you have a perfect credit score, you're still paying over 7% for a mortgage right now. I'm friends with a really good real estate agent, the top selling one here in the DC metro area. They're telling their clients not to buy. So not to use mortgage, not to buy, can't make money off most of their property. So unless you have all cash, you're an all cash buyer. I mean, most people are not. The amount of buyers available, we're looking at a pretty large real estate crash here in the United States in the not too distant future.
You're right, but Jason, they don't have to raise rates anymore. I mean, we're already at a level where we should see a correction in price. It's just a delay factor from when rates are raised until that gets passed through to the real estate market. Again, you don't have a market that's priced in real time the way you do stocks and bonds. And so what do you have? Delay factor, maybe it's 12, 18 months before you really begin to see the impact of those 475 basis point hikes that you talked about earlier. 7%, that's going to hurt. That's going to hurt a lot. And if part of that is just you've shrunk the audience, there was a bunch of people who could buy the average single family home, which is now priced at, what is it, 460, 470, that's 100,000. And at 3%, maybe you can make that work off of your monthly budget. And at 7, you just shrunk the audience. So if there's not as many buyers, then there's a question of what the price can be to attract those buyers, which means the price has to come down. So will it be a crash like we had in 2007, 8, 9? That remains to be seen, because we've got some really interesting supply and demand dynamics. So if you're just focused on the financing aspect, yep, there should be a correction. But it may not be as bad. It may not be as bad given the fact that we've got pretty tight supplies, and we'll just have to play out. As you said, though, even though we have tight supplies, you've got people who could step in, and they would be advised by someone who's in the real estate market to just wait. Why? If you care about your client in the real estate market, I think you got to give that advice.
There's also not as many subprime borrowers. So there's not people with 4, 5, 6, 7 condos barely making the interest payments that were subprime borrowers that were 2004, 5, 6, and 7 leading up to that real estate bust. So there's not as many of those as there was 15 years ago during the last real estate bust here in the United States. But the other problem is, David, that this has really changed with pension fund allocation. A lot of these pension funds have gone over 20% allocation. Some of them are 30, 40% with additional leverage into real estate investments.
It's a great point, because with those institutional buyers, you've got purchases which were price insensitive on the way up. And we think of supply and demand as it is today. What if you end up with a price insensitive seller coming from the institutional markets and saying, yeah, maybe our unit cost was too high, but we got to raise some capital. And all of a sudden there's an extra 50,000 units available on the market. Well, again, price insensitivity matters. And, both in terms of price, pushing things up, but also in terms of collapsing price if you're just dumping stuff onto the market. And that's a dynamic we haven't had to really deal with, because you do have private equity groups and very large asset managers back up the truck. And in single family homes, that was really intriguing to them. So that what would be the circumstances that would turn them from buyer to seller? I don't know, but again, you're not talking about your neighbor who might be holding on for that last $5,000 and really is not willing to compromise with a buyer on that price. They can just dump to regain some capital on their balance sheet.
If there is wide scale selling, though, in real estate and real estate prices crash, won't that destroy the finances 6, 9, 12 months afterwards for state and local governments, though? Because I would argue that a lot of those local governments, state and local governments, are way overly reliant on property taxes, other taxes with real estate capital gains tax. The U.S. federal government has become increasingly reliant on capital gains taxes for stocks, bonds, real estate over the last 15, 20 years. Don't you think that a bust scenario, deflationary scenario, that would probably accelerate the likelihood of the Fed doing a pivot then?
Yeah, I mean, asset price deflation, to be clear. But yeah, that would definitely have an impact on property taxes, municipalities, budgets. Sometimes they're a little stubborn in terms of moving down the estimated value of properties. Happy to raise them so taxes can come up, and a little reticent to lower them quite as fast.
As a second generation money manager, I know your dad has written a lot about this, Don McAlvany, in newsletters, and I know you study this as well. In past deflations in a democracy with the US as the world reserve currency, are they going to change the rules? Are they going to manipulate asset prices? They're not going to. Do you think that they're not going to allow deflation for a long period of time then?
Well, I think what we know from history is that there's chosen winners and losers, and so it remains to be seen who the policymakers are going to choose as the designated loser. And will it be the middle class with housing, or is that something that they'll try to backstop as much as they can? Deflation is not something that I'm waiting around for on a universal scale. But housing would be a good example. Here you could have a collapse in a particular asset class, a particular sector, and then a political choice. What are we going to do to make sure that our constituents are taken care of? And so it would be a question of the creditor or the debtor being the winner or loser. And so in a democracy, that's a helpful caveat there, because it really is in a democracy that credit becomes politicized. And it doesn't have to be smart decision making. It's very pragmatic. It definitely relates to your 2 and 4 year cycle. And who's it going to be? Is it going to be the cities over the towns? Is it going to be a particular income bracket? That there's no doubt that the carnage is going to be concentrated, but it may not be where you think it is, simply because politicians will infuse themselves into that deflationary scenario and determine who pays the price.
Yeah, I agree. In polling, the voters are actually saying, and this doesn't make sense to me because I study Austrian school economics like you, David. The polling is saying that Americans favor more stimmy checks. They want checks sent to them to help fight inflation. I'm just thinking that's growing the money supply. It's not creating new supply of products, services. It's not bringing new oil and natural gas supply, diesel supply online. It's not bringing anything that would actually fix the problem long-term online. It's just giving people more currency to buy things. It's just going to make things worse.
Well, I mean, isn't that funny that we're kind of, in that sense, if we do see more STEMI checks coming, reliving what we saw in the 1914 to 1918 period, where the view was there's not enough money in the system, let's print more money. And lo and behold, high prices needed more money to solve them, and yet more money printed created even higher prices still. That connection was lost on the PhDs, so many decades ago. And the fact that it's lost on the man on the street today, probably not a surprise. Probably not a surprise that voters would ask for STEMI checks and not appreciate that would be a major inflationary thing. The front edge of this inflation, you can talk about monetary policy and the things that we've done from a quote unquote inflationist standpoint for many decades. But the big transition was when fiscal policy got involved and basically trumped the monetary policy side of things. The STEMI checks were a big part of that. So now you've got excess demand, and excess demand, creates even greater problems coming out of COVID, but it creates problems anytime you're looking at it, whether it's a global pandemic or not, with the supply chain. Excess demand, too much demand for products in a short period of time can't be delivered, and all of a sudden you've got a backup. Now prices are moving higher still. So totally agree with you. That's a bad idea. Putting more money in people's pockets, at least from an inflationary standpoint, it's going to make things worse, not better.
And governments, politicians, bureaucrats, regulators, central bankers also created problems on the supply side. So they shut down the economy. They made the supply chain bad. In a lot of different countries, oil and natural gas drilling is banned. In the European Union and United Kingdom, there's not as much natural oil and natural gas drilling. So they have to import almost all of their natural gas. So they're relying on very expensive liquefied natural gas imports. They shut down their nuclear power plants. So they're really just shooting themselves in the foot like a Looney Tunes commercial, Yosemite Sam.
Paul Tucker is a guy who was at the Bank of England for a long time, and he wrote a book back in either 2017 or 2018 on how bureaucrats need to kind of stay in their lane. If you have some sort of technocratic genius, don't try to solve the world's problems. Just focus on what you're good at. And so, energy policies and global warming and you can like throw a social justice. You can assume that Jay Powell like holds the keys to the kingdom and can solve all things, but he can't. No bureaucrat can. And this is sort of a vast reappraisal of this PhD class. What are they doing? It's not just that they're making wrong decisions, but they've got their nose in areas where they have no expertise. And just because you're good in one area, arguably, it doesn't mean you're good in all areas. And I think that was Tucker's point is we have a coming reappraisal of genius. Who was, and how are we treating the quote unquote genius class going forward?
Do you see long-term supply problems continuing for a lot of these commodities?
Yeah, I mean, you've got underinvestment in energy, a decade's worth of underinvestment. And this is a part of, the political howling about, you're not doing enough. Well, any energy CEO could say we've done a lot, but what we haven't done is because you've created policy ambiguity for us. We don't know what you're going to do to us when we start finding oil, or gas. And so, there's been underinvestment in some critical commodities needed. And, if you did want to make the transition towards, an electric universe, an electric world, we haven't done what's necessary in terms of digging in the dirt to make that happen. Show me the lithium, show me the nickel, show me the copper. It's not at a point where we've got so much surplus that we could double, triple, quadruple demand to change the world towards those sort of ideals. So, not only are we in a tight supply demand equation today, but if you increase the demand side at all, now you're talking about seeing prices in the commodity complex do some crazy things.
And capital is not available now for a lot of these commodities producers because the futures contracts for these commodities the last 6 months, not every single one, energy would be one of the main exceptions, but a lot of them have crashed. So there's not capital available. We're looking at potentially, David, if things continue to play out with the Fed rate hikes, the dollar rally, the dollar wrecking ball, other problems, inflation in the emerging markets, and other problems in the global economy, we could potentially see at the same time, and this is scary to me, I would consider this a total chaos scenario, demand destruction, but also supply destruction as well simultaneously.
You paint a very rosy picture, Jason.
Well, I try to be realistic for our listeners here, and there is investing opportunities in this crisis, though.
There is, and I think one of the things that's required to take advantage of opportunities is adequate liquidity. So does cash make sense in this environment? Yes, but you'd have to have your head checked if all of your liquidity was in US dollars, or pick your poison, what other fiat currency. So some balance of a liquidity position where you have gold and whatever, again, pick your fiat. That balance has to be struck, because you do know that policymakers will abuse their currencies, for larger policy objectives, even if it is sort of survival. But so I think the investor who wants to take advantage of discounts in the market has to be smart about how they manage the liquidity. We did something called vaulted.com, which is our iteration of a bank or a cash savings alternative in ounces, partnered with the Royal Canadian Mint. A great program. There's others out there like that, but I think just figuring out how you want to own really inexpensive bullion as a balance to your cash deposit, that's going to put you in a great position to be able to redeploy capital to areas that have experienced financial market chaos, and now from a price perspective, show real value.
So almost everyone in the gold and silver community is talking about this lately. The premiums for American silver eagles are over $10 an ounce. You have online bullion dealers wanting to pay way above spot prices for silver eagles, I think above $10 an ounce, and then they're reselling them for even higher than that. Is there actually a silver shortage, though?
Well, one thing's clear. If you find a bullion dealer who is willing to pay you, a high premium, and then turn around and sell it to another client for a higher premium, you should never do business with that dealer again. Think about what they're doing, burying that next guy, right? Of course, they're the middleman, right? Just be a fair broker. No, it's not smart. We've come out of hundreds of thousands of eagles and moved clients to 1,000-ounce silver bars. We wouldn't touch those eagles with a 10-foot pole. We will not recommend them to a client, because we know how much damage we're doing if that were the case. So be very careful. I see that. I see the ads, and someone who is buying over here and pushing them into another client's portfolio. I think it's unconscionable. But what we're dealing with, more to your question, what we're dealing with is reasonable demand in particular products. And, you're really defining a couple of different kinds of investors, because you've had liquidations, pretty massive liquidations this year from your exchange traded funds. So you've got one kind of investor who's exiting gold and silver, another kind of investor who's entering the gold and silver market. And there's not a lot on the physical side of the market for small investors. And by small investors, I mean somebody who's buying anything 100-ounce size and lower in silver, or your 1-ounce products or whatever in gold. So the premiums are real. They're having a hard time with the blanks, finding enough to line up production for next year. So these premiums may be with us for a while. But I would just say, where you can, avoid them by scaling up in terms of the product size. If that means opening up an IRA so that you've got funds and you don't have to worry about delivery of a 1,000-ounce bar, then do that, okay? Because you don't want to pay the small coin premium. You got to have 100% gain just to be at break even. And even if you're a bull, you don't have to be stupid about your money. And I think that would be stupid.
So what's going around about lack of available supply in the COMEX, the different categories with the register, do you think that's overblown then?
Well, we talk about rules being changed in the middle of the game, and how that might apply to the treasury market. You appreciate that most of these games are fixed, and COMEX can change their deliveries anytime they want. If they get between a rock and a hard place, they can settle transactions in cash and instead of in kind. So the day they run out of silver, the day they run out of gold is not the day that prices skyrocket. It's simply the day that they're settling those transactions in cash. And you thought you were going to squeeze them, they will not be squeezed. That's just, they operate and can rewrite the rules. And same's true in the treasury market. As we described earlier, same's true when it comes to ultimately, politicians choosing who the winners and losers are. So I wouldn't be waiting around. I think that argument is a little overblown. Yes, you can look at the commercial interests and your other interest and your large spec interests, and they tell a very interesting story as to where you're at within a cycle. That's worth paying attention to. But I wouldn't base your bullish case on COMEX running out, again, because they write the rules and can rewrite them instantly.
Yeah, I totally agree. I know another money manager that ordered 1 ton of physical silver from the COMEX, and that shouldn't be a problem at all. I mean, the COMEX has a lot of, back then in 2009, they had a lot of silver. 1 ton shouldn't have been a difficult amount to get it delivered, and it took over 6 months. And he didn't get anything else, any bonuses or anything like that, any discounts. It was, oh, you have to wait. Oh, you want metal? Oh, we're going to make you jump through all these hoops, pay all these extra fees, and it's 6 months. So they could literally do whatever they want, change the rules and screw you over, or they could force cash settlement, like you said.
Yeah, it's a fun world we live in. It's just one that you've got to pay attention to the I's being dotted and T's being crossed.
Well, with the weakness in the US dollar gold price, David, I see a lot of foreign demand for physical gold. Premiums in China only about a month ago were up to, I think, $50 an ounce. So in China, where there's limited investment options for affluent people in China, there's not with stocks crashing, real estate crashing in China. They're having a tech bust and a real estate bust basically at the same time, and a lot of inflation in China. A lot of people are still buying physical gold, so demand is strong outside of the U.S.
Yeah, Jason, I think you're right. There's such an interesting story to be told if you look at geography, because there is strong demand in regions of the world, and we see that in Europe, we see that in India, we see that in China. European demand obviously strong, partially because of what's going on in Ukraine and Russia, partially because they've got double-digit inflation rates. Partially because there's some concern about what the European economy looks like, or even if the EMU system, the European Monetary Unit, makes it through this particular chapter in history. So hedging bets is more popular there. Probably not a surprise. Very surprising, though, was to see that in the first 3 quarters of the year, we've had central bank demand exceed any other year going back to 1967, and we still have a quarter left. So, 3 quarters compared with full year purchases, central bank demand has been incredibly strong this year. Probably would have seen even lower prices in US dollar terms if that hadn't been the case. But I think the investor who is exiting the metals market and thinking they're a genius, it's that Western investor coming out of ETFs. And I think they're going to look back 6 to 12 months from now and realize that it was a mistake. It was a big mistake. They're the ones who they're the future buyers. The sellers of 2022 are the future buyers, in line behind the rest of the world and the central bank community.
That story actually just came out yesterday on Tuesday, November 1st. It's on Kiko. I'm reading it right now. It's from the World Gold Council's quarterly report. 400 tons of physical gold were bought by central banks in the third quarter of 2022, marked a 300% jump from the same period a year ago. And the pace we're on now, year to date, 673 tons officially, the most purchased by central banks since 1967.
Big numbers, big numbers. So what are the central banks thinking as they look and see the dollar move to new highs? Are they assuming, the world's moving into a deflationary scenario where we need to have dollar assets? No, actually, they're saying we're comfortable increasing our ounces, and we see some fragilities in the system that exists, and we don't know what this means exactly, but pretty broad based. If you're looking at the individual countries that were part of that purchasing, it's not one bank that bought a ton. It's a bunch of little banks that bought, for them, what was a lot, and in aggregate is a lot. But I like to see that. I like to see a broad base move. And not just sort of a single buyer or a single seller.
I think there's a lot more inflation outside the United States right now. As bad as stagflation is here in the United States with supply chain problems, high energy prices, it's even worse in a lot of other countries like the European Union, China, emerging markets. But if there was a deflation, if there was worries of a long deflationary period, David, wouldn't there be more demand for US treasuries? Because then people could get, quote unquote, a risk-free rate than at a higher interest rate buying US treasuries that are guaranteed by the US government.
Yeah, I mean, I think a reasonable case can be made if you're looking at a 34% decline in longer dated treasuries. Certainly, if you're even just playing for a bounce over the next 12 to 18 months, I think that could be an interesting trade. Would I be an interest rate investor, a long-term bond investor in the U.S. market? No, I think if you go out even further, 5 or 10 years, then we repeat a chapter in history where treasuries were once called certificates of confiscation. But having seen so much drama in the bond market year to date, it's not unlike equities. It's not unlike equities. In the context of a long-term secular bear market, you have these short and sharp reversals in the opposite direction, and we're due for a big bounce with U.S. treasuries. So I know that's a different point than you were making in terms of sort of a migration to treasuries in the context of a deflation. But I think we have entered a longer term bear market in U.S. fixed income. And, we'll see how this plays out. I've only been wrong for a decade. because I thought that boat was going to turn sooner. But 40 years in one direction is the longest directional trend in interest rates in all of US history. Previously, it was 36. And the average in terms of interest rate trends, either up or down, well, the short is 22. The average more like 30, call it 30. So we made it. We made it to 40. And I think rates now grind higher, not on a straight line. But playing interest rate volatility, I think could be profitable in the long bond. I just don't know how to do that, when to do that, and certainly what happened today would suggest some caution because Federal Reserve is not finished yet.
And high energy prices, energy and electricity, so diesel, natural gas, oil, electricity prices, those seem to have broken the global economy, and the major manufacturing countries that would run these enormous trade surpluses and then recycle their reserves, their foreign exchange reserves, run from trade surpluses into US Treasuries. So Germany, Japan, China, those countries that would normally run enormous trade surpluses, they're not running those trade surpluses anymore. So those countries used to be the major sources of demand for buying US Treasuries, and they're not there anymore.
Represents significant change. Yeah, it's a very significant change.
Yeah, so I would say the energy prices actually have thrown the monkey wrench. The higher energy prices have thrown a monkey wrench into a lot of the plans here for the US federal government and the treasuries. A lot of the major demand component they thought for the treasuries are gone because of higher energy prices and no more trade surpluses.
Right, and in the category of how we win friends and influence people, we're not exactly doing well with our PR plans with anyone in the Middle East. OPEC's not happy with us. I wonder why. And Saudi's not happy with us. I wonder why. So we could have played this very differently and haven't. We've been bellicose and verbally muscular at times when maybe we didn't need to be. But, diplomacy, not something that's been practiced well in recent years, and that's going to come at a price too.
What are your thoughts on central bank digital currencies? Do you think that that's the path that a lot of these governments want to take in the next 2, 3, 4, 5 years?
Well, I guess it depends on what your opinion is of government in general. And when you hear somebody from government saying, "Hi, I'm here from the government. I'm here to help you," do you believe that's true or not? Would there be a different set of agenda items or priorities as they rolled out products like the central bank digital currency? It's efficient. It's we don't. What about seniorage? I mean, it's cost free. You could make a case that this is just good for us, right? But I would want to throw on that more skeptical cap and say, what's going on here? What's going on here? On the plus side, maybe the black market disappears, and the argument has been certainly from who's the guy who wrote The Curse of Cash, Ken Rogoff, that we got to do away with money laundering and illicit crime and drug running and human trafficking and all these things which are driven by cash. So let's get rid of cash and do something that's traceable. Well, when everyone's traceable, no one's really free, and nobody cares about freedom. And of course, the question is thrown back on the person who wants freedom. Well, what are you trying to hide? What if I'm not hiding anything? What if I just don't think that my activities are any of your business? And I recognize we're moving into an era where that doesn't really matter. People don't care about privacy. Everything's tracked online. So maybe we are done with that being a social priority or a value that as a country we elevate. Maybe it's done. Maybe that's history. But even beyond what's lost, what's gained, I don't think is good. What's gained is the opportunity for central banks to manage monetary policy much more effectively using a digital currency at my expense. Jason, let's say you've got $100 in the central bank digital currency, and you're doing something that's not very smart, according to the current economic theorist. Maybe that economic theorist is sort of a holdover from John Maynard Keynes. Why do you have savings, Jason? Why is that not in the system? Why is that not being turned over and over again for the betterment and benefit of all society? What are you thinking, Jason? I'm going to encourage you to spend your $100, and if you don't, it'll only buy 98 cents tomorrow. So digitally, I can manipulate and control, kind of with carrot and stick, the purchasing power of your savings. And then think about one step further. What if I have a preferred way to spend? Jason, I'm going to discount your costs for energy, specifically with your vehicle. If you have an electric vehicle, your dollar buys $1.20 as you charge your vehicle. Oh, and by the way, if you still have one of those nasty, world-destroying fossil fuel burning, combustion engines, that your energy you're going to pay a premium for. A central bank digital currency introduces this world where whatever value set you have, let's just hope it's a good one, but whatever value set you have gets to be imposed on everyone on a universal scale, because you're controlling the price structure, and you can do it universally with the stroke of a key on the keyboard. So that to me, again, it's very Orwellian. It's very Orwellian. And note, more and more people are comfortable with that. I'm not, because I can think back to a number of instances in the 20th century where total control and domination didn't end up being good for the people, even people who thought they were being given a leg up. I mean, the great catastrophes of the 20th century, where you can stack the bodies 20, 30, 40, 50, 100 million deep, were because Big Brother was trying to help you, right? So when government shows up and says, I'm here to help, maybe it's different this time.
No, I don't. The history says otherwise. I mean, the history of governments is violence and brutality. So, and forcing people to go to war. And then also inflating the debt away. So these central bank digital currencies, the government could track and tax every transaction. I mean, they could, Taiwan has already done this to a smaller extent. They could put an expiration date on a stimmy check or the currency in your account and say that you have to spend it. You can't save it. You have to spend it, or they're going to pull it from your account, make it worthless, remove it from your account, or shut down your bank account or credit card because of your social credit score, because of a social media post or something that you did or said that the government didn't like.
Yeah, it combines the quote unquote magic of Keynesian demand management, where you can get the money into the system and destroy the rentier class, make sure that the dollars are churning through the economy and not on the sidelines as savings. And at the same time, as you said, introduce some sort of a social overlay, sesame credits. You're no longer a good citizen. Your money doesn't buy groceries. It doesn't. It's like it's hard to imagine, but then it's actually not that hard to imagine.
Well, I mean, they've done it to certain celebrities already, like Edward Snowden. Even though I think he's a whistleblower, he was labeled as a traitor. So they kicked him out of the United States. They shut down his bank accounts. They shut down his bank accounts, his assets. And then now they're doing it to Kanye West for certain social media posts. You had his bank say that they won't do business with him because of certain social media posts. So at first, they're just doing it to certain celebrities, but soon the group will become larger and larger and larger of people that the government says are bad people.
It's interesting to me, Jason, how the more left-leaning media has cast Republicans as fascists or Trump as fascist, when in fact many of the things that have happened in recent years have come from the left and are nothing but fascist. What you just described is this marriage of a political prerogative with a business mechanism, and all of a sudden the banking industry, in this case JP Morgan Chase, cutting out from the banking system. That's interesting, but that's real-time fascism. If you're looking at your definitions, your actual definitions of fascism, the marriage of political interest with business power, that's interesting. It's dangerous. More and more, it seems like what some people are accused of is what others are actually practicing themselves. So I think it's really important that we be critical thinkers, that we define our terms as clearly as we can, and hold people account for sort of sloppy intellectualism.
This is actually similar to the social credit score and the penalties that people in China and under the Chinese Communist Party have to deal with. So that model is slowly being adopted by Western countries, the China model,
with corporations being complicit.
Oh, yeah. Look at what PayPal said that they took away the $2,500 fine, but apparently a couple weeks later, they snuck it back into the new user agreement hidden in a bunch of legalese hidden in deep paragraphs in tiny little font.
Well, we'll see if there's any more freedom of communication when it comes to Twitter under new ownership. But I think that's where social media has and big tech has played a huge part in changing the way we engage as a society with each other, with the things that we've viewed as sort of the ideals upon which the country was based.
Well, I mean, some of these big tech companies were funded. The seed money came from government entities like the NSA or the CIA and Facebook. Mark Zuckerberg was selling facial recognition software to these government agencies too, making big bucks. So the pictures and the facial recognition software.
Jason, it's an interesting world, isn't it?
It's becoming more confusing and more, I would say, less free. So unfortunately, I see governments changing the rules all the time. That's the one thing I'm confident in is when the government gets in trouble or the central bank gets in trouble, they're just going to keep changing the rules.
Right. How we engage is going to be important. I think one of the things that I like, and of course I'm biased, we've been in the business for 50 years now, but I like gold because it's one of those things that maintains autonomy. As I think about the importance of agency, if you're going to move to sort of a philosophical term, your ability to choose and operate and be someone who determines their own outcomes, expresses their own prerogatives, it takes resources. I mean, you can see when a system is clamping down on people, resources are limited, and your access to them, your ability to use them, all of that is taken away. And I love the fact that you have assets that are private, portable, and give you that. And this is, you can go back to Greenspan. Yes, he sort of turned very practical or turned code at some point. But his article or essay, Gold and Economic Freedom, underscored that point in the 1970s. Maybe he wrote it in the 60s. I forget what year it was written. But Gold and Economic Freedom, if you haven't read it, consider it a careful study for this next weekend, because he gets to this issue of, as the world is changing, he doesn't direct his attention this way necessarily, but I would combine these two ideas. As the world is changing and you really don't know how to land, where to land, what to do next, you better be able to maintain your autonomy and your agency. And I can't think of a better asset than gold to do that.
Gold, silver, other commodities, those are inflation hedges. Historically, that asset class performs well in inflation compared to the other asset classes. Plus, central bankers and governments can't print it. And also, if they're going to put policies that prevents commodity supply from coming online, I think long term, there's going to be supply problems for a lot of these commodities like copper, silver, so many of these other industrial metals, especially energy, because these governments look like a lot of these governments are anti-nuclear power. And then there's still a lot of oil and natural gas drilling bans in so many different countries.
Yeah, I mean, and we are in our asset management services, we're very interested in commodities. You and I have talked about energy going back many, many years. And I think what we like about gold in particular, as it relates to this issue of agency, is there's very few assets that I could physically hold $1 million worth of. Physically hold. Do I like silver? Absolutely. You dump $1 million on my desk and my desk is dead. There's nothing left. It's splinters. It's toothpicks. $1 million of gold, that's different. $1 million of oil. I mean, just imagine the space, right? So there is a practical issue with many of these things in terms of your freedom of choice. And I recognize that this has been the big drive towards digital currencies because they provide something that is even more seamless in terms of transactability, transportability, and privacy, except maybe privacy didn't ever really exist there. But at least in terms of transactability and transportability, there are some very intriguing cases to be made for the digital currencies. Not an investor, not particularly a fan. Again, going back to Rogoff, he made some noise a while back. What the private sector innovates, the government will ultimately control, regulate, and confiscate is what he said. And I think that's the drive towards digital currencies. Is it will be an acceptable form of transaction, but it won't be in a private form. It'll be in the publicly blessed form by the powers that be. So, again, Rogoff, what the private sector innovates, we've certainly have it. It's been beautiful to see. The public sector regulates and then ultimately absconds with.
And there's definitely a global debt problem, but it seems these governments want to inflate the debt away. They just want to fool as many people as possible that, oh, we're going to fight inflation, we're going to raise interest rates, where the central bank is reducing its balance sheet. But ultimately, the debt is still growing for a lot of these countries. And I don't really, unless there's going to be a debt jubilee or a new type of system and they're going to wipe the slate clean, they're going to have to inflate the debt away. The math just doesn't work.
Yeah, and this is, I sometimes get stuck in the dark halls of academic research papers. But 2010 and 2013, there were papers written both years. I think 2013 was the year, with central bankers here in the U.S. as well as in Europe, Bank of International Settlements, considering the value of a flexible inflation target. And how does that translate exactly? Well, 2%, popularized by New Zealand, now popular all over the world. Why isn't it 3? How about 4? And when you start hiking the inflation target, you're raising the acceptable amount of money you're stealing from people's pockets. And 2% is a small crime. 4% is still a small crime. At what point do people start saying this is high crime? This is high crime. This is treason. You shouldn't be doing this. You're robbing those living on a fixed income. You're robbing pensioners. This is not fair. It's not right. There's an ethical issue with inflation targeting. But whether they announce that or not, they can still maintain, as you just suggested, an unofficial inflation target that's 4%. So yes, we're struggling to get to 2, and somehow it's stubbornly at 4 for the next decade and a half, 2 decades, 3 decades. They're inflating away the debt. They're choosing the losers. Like I said, from a policy perspective, they'll choose the winners and losers. And running a higher inflation rate, even than the official target, maybe you just lie about the statistic. They've never done that before. What that allows them to do is take care of the debt problem. And that is better than default in terms of its implications for the financial system. It's the household, it's the saver, it's those living on a fixed income that ultimately pay the price. Chosen losers.
And I remember Janet Yellen years ago when she was running the Fed saying there wasn't enough inflation. Inflation was too low. That was what, 2014, 15, 16, I think. She was saying how inflation was too low. We have to figure out new ways to get inflation. Be careful what you wish for. Now there's too much inflation. The government's going to pretend that they're going to fight inflation. Meanwhile, the U.S. federal government, the politicians, both political parties, Republicans and Democrats, all they're talking about here in D.C., they're not talking about cutting spending. They want to spend more.
I have this picture of Grandma Yellen serving up, fresh baked cookies, and somehow nobody could afford the milk to go with them.
or their weed brownies passed out at a weird DC party.
Janet might really be quite interesting in that environment.
We're going to keep this PG. We're going to keep this discussion PG. So we're not going to talk about the not safe for work DC parties that happen here with the grossly overpaid government employees and people at the Federal Reserve Bank that trade on inside information on stocks and bonds.
I don't know what you're talking about. These are people with impeccable character. They'd never do that.
Oh, okay. I've only lived here for 20 years and heard the most.
We live in Durango, Colorado. I don't get out much. Maybe I lack the imagination.
Well, let's end on that. Let's end on that note, David. I want to thank you so much for your time. You are a wealth of information. Please tell my listeners about the McAlvany Group of Companies and also the McAlvany Weekly Commentary.
Yeah, so I'll start with the commentary. We've been doing that podcast for 15 years, once a week, and we've gotten to visit with some interesting people and have some good conversations. We try to keep people informed, as you said at the start, with some global macro issues, but ultimately how it translates to asset price performance, behavior, et cetera. We've been in the metals business for 50 years. This is our 50th anniversary, 2022. My dad helped get gold legalized back in the 70s, worked with Senator Jesse Helms' office to move the needle on legislation. After a lot of decades of that not being possible. And we were able to get into the business through a tax loophole, which gave us a first mover advantage in providing metals to Wall Street firms there in the early 70s. continue to provide those services to individual investors. Our asset management company focuses on hard assets. We just more broadly define them in terms of global infrastructure, global natural resources, specialty real estate, and precious metals, specifically the mining shares. We've known that space for 50 odd years too, and navigate it well. Have an amazing team, a very tight process, and have outperformed the market handily this year in a down market. And hopefully that continues through year end. Tough markets, but a great team. I'm surrounded by great people, Jason, and I'm very proud of both the metals guys as well as the asset management team. Just couldn't be having more fun. Part of it is because we get to continue to learn and grow. And I think that's what I hope your listeners continue to do. We are in the process of increasing our knowledge base so that we can make wiser decisions with the resources that we have. I think that's why you have the audience that you do.
Yeah, we just crossed 50,000 subscribers on my YouTube channel, and I'm almost at 10 million views. It's been an uphill battle, though, the entire time.
Well, congratulations. Uphill battles require fortitude and determination, and I've known you long enough, Jason, to know that you've got those.
Thank you so much for your time, David, and maybe you'll want to have me on as a guest in the near future, since I'm a young adult and I could provide some input there for some insights.
Absolutely. A little coaching, and that's a good idea. Great to be with you again.